In the span of 48 hours, silver went from looking unstoppable to looking untradeable. 10, that is not a normal correction, that is a forced reset. And here's the part that breaks the usual story people tell themselves. Markets don't usually move like that because everyone's suddenly changed their mind about jewelry demand or solar panels. Moves like that happen when leverage gets cut off. No, they get liquidated. They said this kind of move couldn't happen anymore. They said liquidity is deeper, instruments are more sophisticated, risk controls are smarter. Yet a market that trades globally, that sits at the center of industrial supply chains and investor hedging, just behaved like a crowded theater with one door. And while most people saw the collapse after it started, institutions were watching a single metric that decides whether silver retests its breakdown levels or rockets back into the void it just created. That metric is margin, not sentiment, not headlines. Margin. Welcome to Market Decode, where we translate complex markets into simple signals before they become the story everyone repeats. If you've ever felt like the real action happens before the mainstream narrative forms, you're in the right place. Listen like you're sitting with that calm elder who doesn't raise their voice, because they don't need to. And before we go further, drop a comment telling me where you're watching from, because this market is global, and the best insights often come from comparing what different regions are seeing at the same moment. Now let's reconstruct what actually happened, because the details matter. Silver had been running hard, and then, almost on cue, the air pocket opened. The drop wasn't just steep, it was fast enough to overwhelm normal buying behavior. Instead of the usual dip buyers stepping in, the tape started to look like a chain reaction. One sell triggered another and then another until the market felt like it was trading in single, brutal increments. In moments like that, people look for one villain. But the truth is more mechanical and more revealing. When leverage is cheap, positions can be held through volatility. When leverage is restricted, volatility becomes an executioner. Silver is uniquely vulnerable to this because it sits in a sweet spot for leverage. It is liquid enough to trade in size, volatile enough to produce large percentage gains quickly, and small enough, relative to major equity or bond markets, that flows can move it. That combination attracts momentum. Momentum attracts leverage, and leverage turns a rally into something that can look clean and inevitable right up until the moment it isn't. One of the cleanest tells in this episode was that changes to contract mechanics were happening right as the market was stretched. On China's silver forward market, margin requirements moved from 19% to 20% effective. January 30th, 2026, and daily price limits widened from 18% to 19%. 1% sounds like nothing until you translate it into cash. If you have $1.5 billion of exposure, 1% is $15 million of additional collateral you have to produce on demand while the market is moving against you. This is what most people miss. Margin isn't a fee you pay once. It's a living demand that changes with the market. Every day, positions are marked to market. If you're long and price falls, you owe variation margin. If initial margin rises, you owe additional cash just to keep the position open. Those are separate calls, and they can arrive together like a double punch. And collateral is not a philosophical concept. It's cash. If you don't have it, you sell what you can. You don't sell because you want to. You sell because you have to. That's how I'm a long-term holder turns into I was closed out in a single afternoon. Now layer in what was happening on the positioning side, $5 billion notional at the time, and that the firm netted more than $500 million as the rout unfolded. Whether you admire that or hate it, it tells you something crucial. Someone was positioned for a break at scale, and they were positioned early enough to survive the chaos. But if you really want to understand why this move felt like a trapdoor, you have to zoom out. Silver is not just a commodity, it's a leverage instrument disguised as a metal. It has a history of rallies that look clean right until the moment they don't, because the market structure invites borrowed exposure. This is where the hidden pattern shows up, and it's older than any current narrative. In 1980, silver surged into a frenzy, and then the rules changed. Margin requirements and trading restrictions tightened into a market already stretched, and the result was a collapse remembered as Silver Thursday. In 2011, silver ripped higher again, and then came a rapid sequence of margin hikes that demanded more collateral at exactly the wrong time for crowded long positions. Price didn't just drift down, it fell hard, because the unwind was not voluntary. Then, look at what those episodes have in common beyond the headlines. First, the rally creates a story that feels self-confirming. Second, positioning becomes one-sided. Third, volatility rises. Fourth, exchanges and brokers respond to volatility by raising margin. Fifth, the raised margin forces liquidation, which increases volatility, which creates more margin pressure. It's a loop. It doesn't require conspiracy, it requires math. Different decade, different cast, same playbook. When silver goes parabolic, the system eventually asks one question: how much of this price is supported by actual cash, and how much is supported by borrowed conviction? Margin is the gatekeeper that answers it. Now, let's talk about the players today, because the modern silver arena has multiple layers that interact in ways most people never see. You have futures markets like COMEX, where standardized contracts represent large quantities of silver. You have clearinghouses that sit between buyers and sellers, guaranteeing performance, and that means they care about collateral more than anyone. You have brokers who set their own house requirements above the exchange minimum. You have producers and industrial consumers who hedge, and they don't behave like momentum funds. You have exchange-traded products that can influence flows. And you have proprietary trading firms whose job is to live inside microstructure and exploit stress. In early February 2026, COMEX open interest was around 156,737 contracts. Each standard contract represents 5,000 ounces. That is roughly 783,185,000 ounces of paper exposure. $6,548 billion of notional silver represented by open contracts. Not all of that is net exposure, and not all of it can demand delivery, but it tells you the scale of the paper layer relative to the metal itself. Futures markets are designed for hedging and price discovery. In a calm environment, they do that well. In a stress environment, they can become a giant amplifier because the system marks everything to market continuously. A small move becomes a margin call. A margin call becomes a forced sale. A forced sale becomes a bigger move, and the cycle keeps turning until enough leverage is removed. The CFTC positioning breakdown adds another layer. Non-commercial traders, the group often associated with speculative positioning, showed 43,475 longs versus 19,172 shorts in the figures being discussed. That tells you the speculative community was net long. That's fine in a trend. It's dangerous in a margin squeeze because the crowd that needs cash is leaning in the same direction. And then there's concentration, 2% of gross shorts. Concentration can stabilize a market when big players absorb flows, or it can destabilize it when size pushes against fragile liquidity. So what happens when a market like that is hit with tighter collateral demands? The weakest hands get taken out first, then the second weakest. Then people who thought they were safe realize they're not, because their broker is raising requirements too, or because their losses have already eaten into their equity. And because futures are leveraged by design, you can be right about the long-term story and still be forced out at the worst possible moment. Picture a crowded bridge. Everyone can stand there as long as the load limits are generous. But if the limit suddenly drops, the bridge doesn't negotiate. It forces weight off. In markets, weight is leverage. And the fastest way to remove leverage is forced selling. Now add one more accelerant, daily price limits. When limits are wider, the market can travel farther in a day. That sounds like more freedom, but in a stressed leveraged market, it can mean larger loss increments before participants can react. Larger loss increments mean larger margin calls. Larger margin calls mean faster liquidations. It's a simple chain. One practical way to think about margin is to picture a nightclub with a strict capacity limit. When the limit is high, everyone feels comfortable and even loud behavior can be absorbed. When the limit is cut, security does not debate who deserves to stay. It removes bodies until the count fits. In silver, the bodies are leveraged contracts, and the bouncer is the clearing system. If volatility stays elevated, the bouncer gets stricter. If volatility calms, the rules soften quietly. That is why margin feels boring until it suddenly becomes the loudest force in the room. Then the room adjusts, without asking permission. But here's where it gets interesting, because silver's story isn't only about futures screens, it's also about dislocation, and dislocation is where you find the biggest clues about what comes next. During the sell-off, the paper price was screaming one message: excess, panic, liquidation. Yet the physical side wasn't flashing the same kind of abundance. 0.6 million ounces on February 3rd, and trackers showed that registered stock had been down about 16% over the prior 30 days. Don't get lost in the day-to-day noise. The point is that the physical pipeline did not suddenly swell as if metal was flooding the system. If a market truly had sudden, overwhelming surplus, you would expect physical availability to look loose and expanding. Instead, the physical category that matters for delivery was not behaving like a fresh glut. That's the first contradiction. A brutal price collapse in paper alongside physical signals that do not look like a market drowning in metal. The second contradiction is time. Paper markets reset instantly because they're financial. Physical markets reset slowly because they're logistical. A futures contract can change hands 1,000 times without a single bar moving. A bar, on the other hand, has to be refined, assayed, transported, stored, insured, and delivered. So when paper price collapses, it can reflect forced selling that has nothing to do with immediate physical availability. That gap can last longer than people expect, and then it can snap back quickly when the forced selling ends. The third contradiction is geographic. Silver's pricing and participation span east and west, and the terms of leverage can differ dramatically by venue. When margin requirements rise in one major region, flows can shift, premiums can decouple, and the global market can briefly resemble two different realities stitched together by arbitrage that isn't always instantaneous. In those windows, the loudest price can be the least representative of the physical situation, because the loudest price is often the one driven by liquidations. This is why the one metric matters so much. Margin is the thermostat for leverage. When it rises, it cools speculative fire fast. When it stabilizes, it can allow the market to find its footing. And when it falls, it can reignite risk appetite. That's an endless debate. Because historically, that's what separates a retest from a rocket. Let's lay out the evidence cleanly. 10, that kind of move is a signature. It's the signature of liquidation. It is the market telling you that positions were being closed by constraint, not by choice. Second, the policy pressure. Margin on China's silver forward contracts moved from 19% to 20% effective January 30th, 2026, and daily limits widened from 18% to 19%. A higher margin requirement is a direct demand for cash. A wider limit allows the market to travel farther in a day, which can enlarge losses and increase margin calls even faster. Combine those, and you've created conditions where leveraged longs can be forced out with speed. Third, the positioning context. COMEX open interest around 156,637 contracts, and a speculative community net long, with non-commercial longs at 43,475 versus shorts at 19,072. In a stable environment, net long positioning can ride trends. In a tightening environment, it becomes fuel for liquidation. The market does not need everyone to sell. It needs enough forced sellers to overwhelm available bids. 2% of gross shorts. That tells you the structure is not evenly distributed. Big players can shape the price response to stress intentionally or not, simply because their size moves the market and their risk limits can change the flow. 0.6 million ounces with a meaningful draw over the prior month. That suggests physical tightness did not magically disappear just because paper price fell. It suggests a dislocation that must eventually resolve, one way or another. Now connect those dots and a picture forms. Silver's rally did not only end because the narrative changed, it ended because leverage met a wall. And when leverage hits a wall, price finds the level where unleveraged demand can actually exist. So what does that mean going forward? Historically, after forced liquidation, you get one of three paths. The conservative path is a retest. The market rebounds from the panic low, runs into overhead supply from trapped longs who are desperate to get out near break-even, and then it fades. In this path, volatility remains high, but the trend resets lower or sideways until leverage truly clears. You'll often see sharp rallies that fail quickly, because every bounce becomes an exit ramp for those who are caught. The moderate path is stabilization. Price stops falling, volatility compresses, and the market rebuilds at base. Physical demand and industrial flows reassert themselves gradually, while speculative positioning becomes more balanced. In this path, silver doesn't need to do anything dramatic to change the narrative. It needs to stop being forced, and it needs time for new buyers to replace liquidated positions. The aggressive path is a rebound that surprises people because once forced selling ends, there's suddenly a vacuum. Sellers are exhausted and any incremental buying pressure can move price quickly. This is the path where silver can look like it's rocketing, not because anything magical happened, but because the market was pushed too far, too fast, and then released. When the spring is compressed violently, the release can be violent too. Which path dominates depends on the metric that started the whole chain reaction. Margin. If margin requirements keep rising, or if brokers and exchanges follow with stricter collateral demands, history says the market tends to lean toward retests and further stress. Not because silver is bad, but because the system is still squeezing leverage out, and every squeeze creates another wave of liquidation risk. If margin stabilizes, and if the market absorbs the new requirements without fresh waves of liquidation, history says stabilization becomes more likely. That's where bases are built, and where price action shifts from forced to deliberate. And if margin eases, or if effective margin pressure drops because volatility declines and collateral becomes easier to meet, history says the probability of an aggressive rebound rises. Leverage doesn't need an invitation. It needs an unlocked door. That's why institutions obsess over this. They don't argue endlessly about stories. They track the plumbing. They watch the collateral mechanics, the rule changes, the clearing conditions, the concentration risk, and the inventory data. They look for moments where public narrative lags behind mechanical reality. This is also why the retail crowd is so often late. Not because they're unintelligent. Because the data that matters is not the data that trends. The data that matters sits in exchange notices, margin updates, positioning reports, and inventory categories that sound boring until they move the price. The information gap becomes a timing gap, and the timing gap becomes a financial gap. And there's one more nuance that almost nobody talks about. A margin hike is not just a one-time event. It can trigger second-order effects. Funds that use volatility targeting can reduce exposure when volatility spikes. Risk managers can cut limits for traders when drawdowns widen. Brokers can widen haircuts. Clearing firms can demand more collateral from brokers. And once those processes start, they don't always stop instantly, even if price bounces. The system develops inertia. So, if you're watching silver now, the most important thing is to watch for signs that the margin pressure is either continuing or easing in practical terms. Not in slogans, in mechanics. Watch whether exchanges announce further margin increases or whether they hold steady. Watch whether daily limit moves are amplifying swings or calming down. Watch whether open interest collapses and then stabilizes, because that suggests forced positions are gone. Watch whether physical premiums diverge from paper prices, because that suggests a real-world scarcity signal. Watch whether registered inventory continues to draw or begins to rebuild, because that changes the balance of deliverable supply. And watch whether positioning becomes less one-sided. And when speculative net long exposure shrinks and then stops shrinking, it can indicate that the purge has run its course. When concentration risk shifts, it can indicate that big players are no longer pressing the same edge. Here's the part no one is discussing enough. A market can be right fundamentally and still get crushed mechanically. And a market can look broken fundamentally and still rebound violently once forced selling ends. Silver lives in that gap because it's both an industrial metal and a financial instrument. It exists in factories and in spreadsheets. And when those worlds disagree, you get dislocation. That dislocation cannot persist forever. Either the physical side loosens and catches down to the paper price, or the paper price rebounds toward the physical reality, or the system meets somewhere in the middle after enough time and enough inventory movement. The timing is uncertain. The direction is not guaranteed. But the tension is real and it's measurable. So the choice ahead is simpler than it looks. It's not about being bullish or bearish. It's about recognizing whether the leverage cycle has finished tightening. If you ignore margin, you're watching the movie without sound. You'll see the characters moving, but you'll miss the dialogue that explains why they're moving. If you watch margin, you can at least understand the rules of the room. You can see when the doors are being narrowed. You can see when the exits are being opened. And you can see when price action is driven by force rather than by preference. There will always be noise. There will always be commentators telling you the move happened because of one headline or one rumor. But when a market drops a third of its value in 2 days after printing 121, you're not watching a debate. You're watching a stress test. Silver's next move, whether it becomes a retest that traps the late optimism or a rocket that punishes the late pessimism, comes down to one metric, margin. The percentage of collateral demanded to hold exposure, the line between a position you can survive and a position that gets closed for you. This is market decode, where we decode what matters before its headlines. If this connected dots you hadn't seen before, you already know what to do. And remember, the question isn't whether markets move. They always do. The question is whether you're watching the metric that tells you why.